able
Benjamin.
to.
Meet you.
All right. Oh, did I not admit him? Oops. Sorry. Okay. Anyways, I'm gonna get us started. Oh, there's Whit. Hi, Whit. Welcome. You're muted. But welcome to the Central Oregon Investor Network Meetup. This month we're talking about hard and private money lenders, but we're actually going to be changing the names of these things as we go through today's topic, because there's like more nuance to this, and I didn't know that until last week when I was prepping with our panel. So, but I think a lot of us have these terms in our head, so we're just going to go with that for now. Let me find my presentation. So, as most of you know, I'm Suzanne Moore. I'm a realtor with Realty One Group Discovery in Bend, working from Baja for right now, but coming back. And then Sarah is my business partner.
Yeah, holding down the fort here in the office with everybody.
So we're a team, and we focus on helping people learn about real estate investing. We are investors ourselves with numerous stores in Oregon and beyond. And this, what we try to do is just bring everybody together, share what we know, but we don't know it all, and bring you all together so that we can learn from each other and make connections and do more deals and make money and be able to do what we want with our money and our time. That's the ultimate goal, I think, of real estate investing. So just how we normally go, we'll just do some quick intros of who's here, and then we'll dive in to the lender intros, the folks we've got on our panel today. We'll talk about lender types, so we're going to change the names of these lenders, and then talk about like different lending terms in terms of like rates and fees and things that you can expect with each type of lender. We'll talk about the pros and cons of each, whether it's an individual private money lender or an institutional private money lender. And then we'll just talk through some examples. So Sarah is doing a flip in Bend right now using one of the funding sources on our panel, and so she'll talk about that. And then if anybody's got a project, actually, I think Karen, you're there, so you might want to share yours as well. We'd just love to hear, what people are doing and what kind of terms you're getting with non-bank financing, non-traditional financing, I guess. And then sometimes we have people ask us how they can put their own money to work. If you, for some reason, if you just decide you don't want to be buying property, but you still want to have your money working for you in real estate versus the stock market, there are ways to become a private money lender. So just wanted to address those opportunities as well here. So we've still got more people coming in, but yeah, let's just go through the list. Let's see, how should I do this? Let's do the people in the room first. I'll let you all go around and then we'll go from there.
Start with you, Benjamin, since you're here first.
Hey, my name's Benjamin. I'm trying to get into real estate for a while. Ended up just landing on wholesale to raise some capital. Just getting into it, just closed my first deal last month. So kind of just stacking up, and eventually try to do some flips myself. That's where I'm at.
Cool.
Hi, everybody. My name's Karen, and my partner and I are builders and getting into real estate development. We've got a flip going on right now, actually, with Bob and Merchants Mortgage. And we're also developing a small hempcrete boutique hotel in Sisters. So we've got the land and the design, and we're looking for financing options.
My name is Zach. I'm a general contractor here in town, in Bend and Redmond. Looking to get into a property that I can kind of manage myself as a fix and flip that I could possibly move into as well. Looking for property for myself. So depending on what property we come across, we'll just kind of determine what avenue is best to take on the project. But currently right now, just looking for a project that I can manage myself, since I've had enough experience in the area and kind of manage the project myself. That'd be it.
Super. And while I'm thinking about it, for anyone that's there and wants to put their contact info in the chat, please feel free to put your whatever you want to share, your email, your phone number, your website, your Instagram handle, you know, whatever that might be. You can pop it in the chat. And then for the folks in the room, there's always ways to share business cards in person as well. But if any of you want to put your info in the chat, I think maybe Sarah might be able to do that just so we can share it with everybody on the call. And then someone else joined in the room. So who do we got?
Hi, my name is Ty Kelly. Sorry I'm a little late. Interested in the topic today though, so glad to be here.
Anything you want to get from today specifically? Just
I've been considering doing a hard money loan for like a foreclosure, and I just have only talked to really like one person being the person I would do that from. So I thought it'd be good to get like a third party kind of opinion on
good deal.
potential pitfalls, I guess.
Good deal. Remind me your last name again, Benjamin.
Alexander.
That's right. Okay. Yeah. That's right. Cool. I know you. All right. Cool. All right.
Katie, I'll answer your question in the chat, but go ahead and introduce yourself.
Thanks, Suzanne. Hi, everyone. I'm Katie. Me and my husband, Miguel, just moved to the area about a month ago and are interested in doing fix and flips in the Redmond area for single family homes. We're also thinking about looking out of state, so also excited for that next session in the upcoming month. But excited to be here. Well, thank you.
Super. All right. Let's see who joined after you. I think it was Cherie.
Hey, go ahead and skip me because I'm at the counter ordering coffee.
Oh, okay. We'll come back to you. Whit. Oh, they're still muted.
What's on mute?
Wait, Whit, you're muted.
There, can you hear me now?
Yep, we got you.
Yep. So I've been a long-term landlord for 37 years, and I'm reducing the number of units I have, and that makes me want to look at whether I want to carry a loan for anybody or potentially be a money lender. So just exploring and learning from that perspective. I'm done.
Sorry, I was on mute this time. Eric.
Hey everybody, my name's Eric. I own 2 rentals, 3 units, a duplex in Portland that I house hack, and Airbnb the other unit to cover my living expenses. And I was connected with the ladies in Central Oregon, Suzanne and Sarah. They helped me close on a purely vacation rental property just south of Sun River. That is a full-time vacation rental. So I'm in the vacation rental space, looking to kind of diversify and expand, looking to do a development project, probably a 4-plex house hack in the Central Oregon area next. And then I also work in the vacation rental property management space. So excited to learn here about different financing options and network with you guys.
Sweet. All right, Cherie, you got that coffee?
I got it.
All right.
Okay, sorry, I'm at Black Rock Coffee. So let me see if I can get outside. So I don't know if there's a lot of background noise. All right. And it's, by the way, it's very, very sunny. It's a beautiful day here in Bend, Suzanne. All right. So I use the slow flip method. I've been doing this for about a year ago. So about a year and 3 months. And I just closed on my 5th door. And my buyer, my first door that I bought, I sold it to our buyer, and he is now going to buy the one I just purchased, and he's going to rent it out to one of his family members. So we love it because it's helping them start their generation, their real estate investing venture as well. So I'm super excited for them. And yeah, so I think that's going to be a trend. Start introducing real estate investing to my slow flip buyers.
I love that.
Yeah.
It's a great way to, bring it around and help other people. And Cherie's going to be our guest speaker at next month's event. We'll talk about it at the end, but in case anyone has to jump off first, next month is out-of-state investing. So I want to be here for that.
Oh, and I probably will have to jump off because I'll be showing some homes in Ohio remotely.
Oh my gosh, I love it. So good. All right. Well, we already did that. Okay. Now we're going into our lender panel. So we've got Ted Spradlin. So Ted, you want to tell us a little bit about yourself and what you do?
Sure. Yeah, I'm Ted Spradlin. Been a mortgage broker for the better part of 23 years. We started this company, a partner and I, in 2013, and we are brokers of hard money loans. It's our main focus. We do some institutional financing, some bank financing, but we started it with the intent to work with real estate investors on their projects, whether that was fix and flip, construction, or long-term financing. We've added 2 other partners in 2018, and we do just over 500 loans every year for just under 500 million in loan volume. Most of it in California, some here in Oregon, Washington, Idaho, Florida, Utah, Arizona. Quite a bit more in Arizona now, but that's our business, and we work with institutional lenders and individual trustee investors, so high net worth individuals lending out their money. Most of them have a background in real estate finance, law, and like to lend their money. That's what we do.
So you've got individuals and more of the institutional in your portfolio.
Yeah.
Okay.
And mortgage funds as well. Whether it's someone's raised 50 million or 150 or 300, it comes in a lot of different varieties.
Got it. Great.
Yeah.
And there's Ted's website at the bottom if you want to check out First Capital Trust Deeds. Next up is Joey from CV3.
Hello, everyone. Joey Zanaboni. Nice to see some new faces and some familiar faces here. I have been in the lending business for just over cracked the decade mark this year, which is exciting and depressing at the same time. But I'm over at CV3. We're a asset-based private money lender. We specialize in fix and flip, bridge loans, long-term rental, short-term rental. We're rolling out new construction in July, excuse me. We are in 30 states currently, including Oregon and most of the other ones that most of you are interested in doing business in. And I've been doing this for a while now. I actually came in, my whole career, I've been in this niche of private money lending, investment lending. I actually studied real estate finance in school, got an internship in San Diego at one of the largest house flippers in the country, and in San Diego, CT Homes. I don't know if any of you have heard of Than Merrill, Paul, and JD Asasian. Those were like a few of the original crew of the original Flip This House TV show on HGTV. So I got to work with those guys as an acquisition specialist. Did that for a couple of years while I was finishing up school. And then I started in the lending business as an underwriter. So I think I come into this position with a unique perspective and experience from both the buy side, the investor side, as well as the lending side, and as an underwriter. So I know how to evaluate these deals. I think, I'm a good partner for you in your journey to, get some deals financed, get some flips under your belt, and looking forward to, sharing what I know. So I appreciate the opportunity.
Thank you, Joey. All right, Bob Thomas.
Hey guys, Bob Thomas. I've been a speaker in this group before. I wear a lot of hats in the real estate industry. In today's hat is going to be mostly on the hard money side of things. I'm a real estate broker. I do kind of commercial syndications and value add commercial real estate operation. And then I also run the Pacific Northwest branch of Merchants Mortgage. We're a hard money private lender funded by institutional capital, mostly like insurance money, owned by KKR, a large private equity fund. And we do residential fix and flip, kind of long-term DSCR financing, basically anything that's non-bank and think kind of bridge or shorter term. That's typically what we play in. Probably 80% of our loan volume is in the residential fix and flip space. And then I also do, given my background with commercial real estate, I really handle a lot of the mid to large sized ground up construction or value add bridge loans for our company, larger multifamily product. So looking forward to kind of chatting through, what the industry is and how you guys can use it. I know some people in the group have used our loan products before, so love some real-time feedback about, what's good and, what sucks too. We want to know what, how to improve and, what you're seeing. And I'd love to hear, if what you're seeing as a potential, pain point is more ubiquitous or if it's kind of lender specific. So it'll be cool to kind of, have an open discussion on this panel. So looking forward to it.
Too many buttons. Okay, so what are your options with creative financing or non-traditional financing? And we talked about this last week when I met with a panel to just get our pretty presentation ready. And the terms have been hard money, which is, kind of what we think of as going to somebody that is like a quasi bank and getting money for a short term and, generally 6 months, higher interest rate, higher than a bank. And then private lenders being kind of like the people in your network that have money to lend out. But I learned last week that they are categorized now as an individual private lender, which is those individual people with money to loan out, versus institutional private lenders. So will someone on the panel kind of expound on that a little bit and talk about why those distinctions are important?
I'm happy to jump in. So I think there's a little bit more nuance that needs to be, kind of brought to this. So what people say hard money lenders, and like Suzanne just said, you kind of think of a Merchants Mortgage or a Civic or, someone like that you go to. But then people also think, oh, well, hard money, that means that you're totally asset based and you're not at all looking at the borrower in terms of their, kind of experience or credit or something like that. And that's really where I think these words get conflated. And so we're trying to do a better job of breaking those apart. And I think the way to look at this financing world is more like, where is the money coming from that these lenders are giving you? Because that usually kind of decouples how the lenders are actually doing underwriting. So I know in our meeting last week, I said, hey, you could have the high net worth individual, your rich uncle Ted, and he's lending out of his 401k, right? He's just an individual guy who wants to put his money to work and is doing it, on individual loans. That's kind of that private lender bucket. And then what we talk about as more, kind of like a business, like a lending business, institutionally financed, they're either selling the loans to large institutions or they have large private equity funds backing them. They have a little bit more stringent underwriting requirements where they're not just looking at, the asset itself, but they're looking at, you as the borrower. Do you have enough, they're going to get your bank statements. Do you have enough cash to do the deal? Pull your credit, and do everything else. Kind of feels a little bit more banky, but still being able to do a deal that is something a bank won't be able to do. And so in this presentation, instead of talking hard money and private money, I think we're going to try to talk about individual private lenders like your rich Uncle Ted, or institutional private lenders like, Joey's company CV3 or my company Merchants Mortgage. And really it's just related to where that money is coming from. Is it just an individual with their own money, or is it someone who is doing this as a business that's getting money from large institutions that needs to, kind of like sell these loans or package them up, and needs to kind of hit certain parameters to do that.
And Ted, it sounds like you're kind of aggregating both sources. Is that correct? Is my understanding correct?
Yes, as a broker of this, we have several high net worth individuals. We have family offices. We have real estate investor funds that also have a lending division. They might manage $6 billion of real estate, but the partners in the company have their own little lending fund of 250 million of partner capital that they lend out. And what happens is, like Joey's company and Bob's company, they'll do a full credit underwrite and do a background check the assets, experience level. We do the same thing as brokers for our trusted investors. We provide all that stuff. We review it just because if it's a new client, we don't want to get them into a bad situation, whether it's an individual or it's a family office or it's a real estate fund. So we're going to be doing that anyway. I guess there are some other places that'll do just, hey, truly asset based, like, hey, the property's worth $1 million, we'll give you 600,000 tomorrow. No questions asked. That exists, but it's kind of dying out. I mean, I think that's like old guys in their 80s who've been lending all of these since the 1960s, and they started out lending $20,000 at one time, and they've just continued to grow. I think that's the model, but I think more and more people are going for more detail, more information, just because litigation, you'll get sued if it goes bad. I think that's what everyone is cautious of, and the industry has evolved significantly over the last 10, 12 years. So it's become more of what both Joey and Bob's company do. It's more, there's a lot more money that flowed into it, and so it's becoming more professional, even when it comes down to just the broker level, like where I'm at. We've had to increase the data and the information that we provide to our investors who are funding the loans.
Got it. Okay. That's helpful. So let's move on. Oh boy. Whoa. Hang on. Okay, here we go. Whoa. So do one of you want to take this one? Just kind of talking about where names came from.
Yeah, I mean, I would just jump in and say, individual private money lenders, kind of as we were alluding to, these are, when we were back in the phase where it was making the distinction between hard and private money, these were the private money lenders. And what people were classifying these folks these are people, high net worth individuals in your network, in your personal network, that you can source capital from to achieve a variety of objectives when it comes to financing your projects. Oftentimes, with the right network and the right networking ability, you can find investors who are willing to fund up to 100%, of your deal, and require little to no skin in the game from you. So, that's one of the advantages of working with an individual private money lender. The problem is they're harder to find. They require more networking, and boots on the ground to go out there and shake hands and meet people that might be interested in funding your deals, and to build a level of trust with those folks to the point where they'd be comfortable lending on your deals. And one of the negatives or downsides of that is, because they're harder to find, that's one. The other is that, there's a little bit less reliability there. How do you know that, that they're going to be able to fund every one of your deals if you start to scale a little faster than you were initially anticipating? And how do you know that money's going to be there when you make the phone call? So really establishing it's a true relationship, and really establishing that relationship with that individual and making sure that money's going to be there when you need it. But these are definitely a important tool for everyone to have in their tool belt. I think it's important to have a balance of both.
Yeah, I definitely agree with that. And you find people who are a little bit more creative in terms of what they're able to do. So they might still be, it's not like these individual guys are just totally not discerning and not, sophisticated. But at the same time, where Joey or my company might not, we'll have different parameters if you're trying to put a second position loan on a property. These private guys might not care about that. And so if you're starting to get creative with your financing involving the seller in a subordinate, second position loan to help fund your equity, these private guys are usually a little bit less likely to care about some of that, like, kind of deal structuring that can really make your equity returns get juiced, because you're, effectively 100% financing a deal. Sorry if that was a lot of lender speak, but if you guys have any questions about that, feel free to speak up. But definitely a little bit more flexibility when it comes to the private guys versus the institutions.
Great. So I think Joey covered this already, but the generalizations for what we used to call just a private money lender, and now we're calling an individual private money lender, is they're shorter term, asset based, perceived to cost more than institutional money, but they don't pull your credit generally, and it's a much more relaxed and informal process, which has its pros and its cons, which we'll go through in a bit. Which one of you take institutional private money lenders?
Joey, go for it, man. You get a comparing and contrasting the two.
Yeah. I mean, I think Bob really hit on it at the beginning of the presentation and gave you a good idea of kind of the differences here. But as this space has become more professionalized, like Ted was talking about as well, and been able to scale and find larger sources of capital with which to work and draw from, it's allowed us to achieve economy of scale and provide more competitive pricing. So generally, when you're working with an institutional private money lender like myself or like Bob or like Ted will direct you to, then you're going to generally have better pricing. They're usually, like Bob was talking about, is going to be some upfront costs. Usually, we're going to want some skin in the game depending on the project type. We're generally lending up to, anywhere between 75 and 90% loan to value on a purchase, and requiring some level of skin in the game from the borrowers. Typically, there's going to be some closing costs associated with that as far as points or origination fees, which are reasonable, but industry standard and generally due upfront when the loan is funded. Although I know there are institutional private money lenders out there that are more flexible on that. But yeah, it's a more cost effective. It does feel like working with a bank in a sense, but like Bob was saying, we have much more ability to be flexible and get creative on some of these deals. And we have more product offerings. And, the other thing I like to touch on when it comes to institutional private money lenders is you are working with true professionals who do this day in and day out and who are trained to assess and underwrite risk. And so, think of a good lender as a true partner in your business and a safety net to make sure that you're getting into a deal that makes sense. I mean, if a deal goes through a institutional private money lender's underwriting process and the appraisal looks good, there's a budget review process that checks out. You've got underwriters looking at the deal to make sure if it's a rental that it's going to be positive cash flow. There's all these different checks and balances with it as you're going through this underwriting process. I think it helps give individual investors a higher level of confidence to know that if this loan goes through the underwriting and approval process and gets approved, it's a sign off on your deal that, if you're able to execute, this should be a profitable deal for you. So I like to view myself, and I'm sure Bob and Ted do as well, as like a true partner and professional who does this day in and day out, who's on your team helping you get these deals to the finish line.
Yeah, and just to kind of continue that thought, we've seen a lot of deals, I mean, just in our business, right? I mean, we're closing, Ted was saying he's doing 500 million a year. I mean, we're all kind of in that mid 100 millions to a couple billion a year ballpark of deals we're seeing. And a lot of this is on a residential size, sub $1 million loans. So we're seeing a ton of volume, different structures, different ways people are doing stuff. So I've always found it better for a client to come to me well before a purchase and sale is even signed, to say, hey, what do you think about this? Do these numbers look good? Is there anything I'm not thinking about? Because we can almost help with like structuring, almost like a real estate broker or something like that, really thinking through, hey, well, what if you, involve the seller here? Or like, what if you swap the purchase price out a little bit? Or, here's the most you can pay for this property. There's a lot of ways where if you come prior to the purchase and sale being inked, we can kind of help make the deal a little bit more kind of nuanced and directed, kind of aligned with your goals. Whereas once you get a purchase and sale inked, then when you bring it to me, you can't really like put the cat back in the bag. And so if you have addenda that are changing the structure of a deal, it's very visible as to what you're doing. Whereas if you just like have it in the initial PSA, it's you can get away and kind of structure things in a way that is a lot more beneficial typically. So always ask for guidance beforehand.
Like free underwriting. I like
Yeah,
it.
100%. and deal structuring.
Yeah, I mean, oftentimes a borrower will bring a deal and they haven't really, they've got a plan A, but they haven't really thought through plan B and plan C, and we can help you do that. We a lot of times maybe a deal, if lenders are going to be concerned about exit strategy. They always want to know how and when are you going to pay me back? And so they're very focused on that and wanting to make sure that, you've got a couple options. So maybe if the flip numbers look a little tight, what would it look like if we were to refinance into a long-term rental, once the renovation is done, and keep that as a rental, or vice versa? Maybe your plan is to do a BRRRR strategy, but costs ran a little high, or maybe it's sitting a little, when you go to refinance, you're not able to pull all your equity out and roll that into the next deal. Maybe you can just put it on the market, make a quick 10-15% return, and move on to the next deal and collect a small win. So these are kind of things that we can help you think through ahead of time.
Or if you're a licensed broker, right, and you're trying to think through, hey, how do I limit my down payment in a deal? I mean, Sarah, this kind of goes to our deal that we did, right? But it's like, or if you're a contractor, maybe there's a way that you can kind of bake in some of the repair costs as like a seller credit that's paid to you pre-closing. And so there, where if you don't have that structured in the initial PSA and you have it as an addenda, all of a sudden the lender is going to say, hey, look, you're just trying to, get cash out at closing. It's not going to work. But if you structure the purchase price and everything up front, you can oftentimes come into close. I mean, I've literally bought an 8-plex, God, in 2018. I walked out of closing with a $250,000 check. And that's literally just from how you structure credits and stuff. And you just don't do it. Like, once the PSA is inked, it's kind of done. And so knowing what to put in up front is really helpful.
Can you give an example of that? Like, how, I don't know, how you could walk out with a check?
I mean, it's basically at some point you're either getting a credit on the settlement statement, or you're getting like a bunch of subordinate debt. But so if like I'm trying to think of Sarah's example. So Sarah, did we attribute your broker commission as equity in this deal?
Yes. Yeah, exactly. Mine was I needed more money, more reserves on hand. Right. And we were looking at and that was either via credits, because I had some credits for repairs. Right. And then also, using my commission as adding.
But so here's the thing, is that most lenders, when there's like a seller credit, they don't want, they won't let you use a seller credit as as equity, as part of your down payment. Like they'll net that out from your loan amount. The only real credit on a settlement statement is a broker commission that they'll fund. And so in Sarah's case, she had negotiated a bunch of seller credits for different things, where if instead we had said, hey, how about we, increase the broker commission paid to her instead of having all these credits for the same amount, well, then that all would have counted as like cash to close for her. So there's, or I mean, like with this whole NAR settlement, I mean, I think Fannie, I forget, I was reading somewhere, Freddie, I think, is allowing up to 9% of, it has to be, market
commissions. Yeah, I've just read that. Yeah.
Commissions. And so if you have like a deal, right, and you negotiate like a net to seller purchase price, and it's a below market deal, well, then why not increase the purchase price and increase your broker commission? Then all of a sudden, like, you're still buying a market rate deal, and you're getting, a ton of cash just from buying the deal to close it. So you can't do, like, if you ink the contract and then you start changing the price and increasing the broker commission on a in an addenda, the lender's going to tell you like to go to hell, because they see what you're doing. But if you do it up front in the main PSA, it's just part of the deal.
Got it. Okay, that's helpful.
I think the last piece, just to touch on there, is, and Bob kind of touched on this earlier, is just that relationship aspect. As you guys start to get more deals done with your preferred lender, it becomes so easy. Just that I can't emphasize how important it is, that reliability and surety of the money being there when you need it, to give you the confidence to go out there and make offers confidently, knowing that your lender's got your back. And, once you get a deal or two done with one of us, whether it's Ted, me, or Bob, it's just a matter of, hey, here's the purchase contract, here's my budget, here's 2-month bank statements, let's go. And it really is that simple. So, you know, that reliability, I think that is what attracts a lot of investors to continuing to work with us, even when maybe they could go out and scrape together 100% financing from 3 different sources.
Sweet. So just to clarify here, institutional private money lenders will verify experience and liquidity and generally require 3 to 6 months of reserves. Will generally run credit as part of underwriting, but it's more relaxed requirements than a traditional bank. And they may do a background check. So Ted, you had added in the background check. Is that something that's pretty standard for your investors?
Yeah, I think it is. And I think with Joey and Bob's company, background check is probably standard as well. I mean, you find some pretty interesting stuff in there that'll kill off a deal. Like someone's got $1 million tax lien, doesn't show up on a credit report, but it's showing up on the background check. Or they've had multiple DUIs in the last year. One more, they go to jail. We had a loan get killed off because of that. The investor's like, I'm not doing that. I'm not going to lend to this guy. Next Dewey he gets, he's going to jail. So, and he'll default on my loan. So,
Now, Ted, are most of your deals like single family, like resi, or are most of them larger commercial?
I'd say we're about 65% residential, 35% commercial.
Got it. Because I mean, so like in our credit check, like we have a little area, like it's like a risk rating thing, but there's no like separate background check we do for our resi guys. But when like I just bought a decent sized multifamily plex at the end of December, used another kind of private lender to fund it, and they did run a background check on me, on my partner, on any limited partner that owned over 10%. And so like what I've seen is that on the larger stuff, you definitely get background checked. On the smaller stuff, it's a little bit hit or miss.
Yeah, for every new borrower, it's kind of a standard practice for us just to make sure we don't get into something where, oh boy, or the person's highly litigious and they turn around and sue every lender that they've had. You know, just going to walk away. Like, no, thanks. I don't want that person. So we're really trying to avoid headaches with the background check.
I think the big thing here, if you look at these bullet points, is like the institutional guys, right? It's all about where's their money coming from. And so they're not just doing this just because. Like what we're able to do then is, you know, we might hold on to some of these loans, but a lot of the loans we end up selling off to larger note buyers. And depending on, you know, your experience or the amount of cash you have in the bank or how much you're putting down or what your credit looks like, these loan buyers will pay different amounts for those different like attributes. And so you're going to get different pricing and different loan structures. Like you know, we can definitely go higher leverage and give cheaper pricing to someone who's done more than, you know, 4 flips in the last 3 years, and definitely better pricing that's more than 10. So there's not, it's not just like, hey, we're doing this because, like, there's for sure a reason, and most of the reasons that these institutional guys work this way is because of how their back end money comes in and how they get funded.
Mm-hmm. And you guys are lending oftentimes you're lending off a credit line or a credit facility at times. It could be, or whoever's buying your stuff is also leveraged as well. So there's that requirement for all this detail for institutional lenders like you guys.
Yep.
There's credit facilities upon credit facilities upon credit facilities backing these loans. So.
And one of our affiliated, we're owned by KKR. They also own Turok Capital, which is one of the largest buyers of these loans in the country. And just, I mean, in the past 2 months, they issued their first rated tranche of these. So I forget if it was Moody's or S&P, but one of the large rating agencies actually rated the tranche of loans they were selling into the markets. So like you're starting to see, you know, 10 years ago, people would have laughed if you had said, hey, we're going to get we're going to get 500 million of these loans rated so that insurance companies can buy them. They would have said, no way, like who wants to do that? But it's really becoming a thing. And so as you're starting to, you know, see these things actually end up in large pools in, you know, kind of institutional funding facilities, like you need this sort of structure to be able to, you know, kind of get to that level of sophistication.
Mm-hmm.
And Bob, you mentioned Turok, and that brings up another point, which is like, there, and correct me if you guys disagree, but there's not that many players in the secondary market that operate at that scale. So, one of the most common questions and first questions that we're always hearing, which is understandable, is like, what's your rate, right? What's the pricing? And, I just want to emphasize, yes, rate is important. There are more important things than rate. We're going to get you the best rate possible. I'm sure Bob, myself, Ted, we're all within a pretty tight range of each other as far as what pricing is going to look like. We have wholesale rates. We have good pricing. The pricing is going to be there, and we're going to get you a competitive rate. We're all relatively similar. What you need to be careful with, and the questions you should be asking when you're approaching or researching a lender, luckily we've got some great ones on this panel, so we're all in the same boat here, is, how quickly and how reliably are we going to get this loan closed? Because your earnest money deposit is at risk. And if you're dealing with a lender that drops the ball and can't close on time, you could be losing that EMD. So, service, experience, and the quality of the lender is so critical. Not all lenders are created equal, despite what people would have you believe. Sure. It's not a commodity. Your experience will be drastically different from one lender to another, from one loan officer to another. There are going to be loan officers that you're interacting with on the other end of the phone that were working for Uber Eats 6 months ago. So, and no offense to anybody that's doing Uber Eats, but like, we've all been in the business for a long time and we're professionals at what we do. And you can trust us that we're going to get these loans to the finish line. So not all lenders are created equal. Rate is not the most important thing. A lot of these loans are being sold to the same place at the same rates.
Yeah. And not just to the closing line, right? I mean, that's really the start, because then you actually have to execute a project. And so you want to also be asking, hey, lender, how does your draw process work? Right? Like, do I have to come out of pocket first and you reimburse me? How long does that take? And then, who services my loan? Is it a third party servicer? Is there someone in house? Who can I be talking to? You really need to ask all those questions, because I'm working with this right now in that multifamily I was talking about. I'm putting a draw sheet together. It took 2.5 months for me to fund my first draw. And we've been coming out of pocket like 40 grand a week on this project. So I was out of pocket like 300K. And this lender I'd submitted my draw and they were just sitting on it. And so knowing they were still the best lender for this, and I'd asked them how the process worked. But there's a huge difference between getting upfront funding from a lender or a reimbursement. And then if they take a while to actually reimburse you, your project can stall out if you just run out of cash. And so knowing all that upfront is super critical.
Sheree's got her hand raised.
I do. So gentlemen, what we do with our business model of, we call it slow flipping, you might be familiar with it. We do look for really true individual private lenders, like you mentioned, self-directed Roth IRAs type of things. There are groups, I guess they would be categorized as institutional private lending, where I guess they're a group of investors and they'll pool their money. But we look at smaller loans for 5-year time period. Is that something that could be possibly done with the model of lending that we do, or that we look for?
Ted, you might have a different response. Like, some of your guys might be open to longer term exposure, but at least in terms of, I'll let Joey speak for himself if he's different. But I'd say most of our terms are in that 9 to 15 month range, and usually on the shorter end of that. If you're looking at how like our companies make money, like we make money through volume on these things, and the rates are pretty high where you don't really want to be hanging in there for more than that time period. So if you think from a fix and flip standpoint, like, we're kind of that bridge lender. And so if you're looking for high interest, high leverage with construction financing, like, think in that 6 to 12, maybe 15 month time frame. I've held a project longer than that with hard money. It sucks. You're coming out of pocket a ton for interest every month. Like, it's really, if you actually run the numbers before you buy the deal with that kind of financing, it's tough to make work because you're paying so much in carry cost. So I don't know how you're funding your deals with these sellers, if it's cheaper if it's cheaper rates or if there's some form of like deferred interest payment at the end, or something like that. But I've always found it tough to make call it 10% interest work for 5 years.
Yeah, so we're not fix and flippers. I guess you would categorize it more like a buy and hold. So we essentially, in a nutshell, because this is what I'll be talking about next month, but in a nutshell, we buy a house like a car, we sell it like a house. Just in that of a nutshell. We don't do any fixing, repairing unless it's very, very little. The buyer that buys our house, they put their sweat equity into it. So what we do is we just borrow from private money. We borrow like $30,000 amortized over 5 years, and we typically pay 12%. So that's what I want to know, if in the individual private money arena that you guys do work with, that's what we're looking for. And it would be nice to have maybe a conversation outside of this meeting if that was something to pursue.
Are your deal sizes like actually, I mean, it's out of state. So are your deal sizes actually 30 grand? Like are your purchase prices 30K?
So my first house was 18K.
Yeah. Okay.
And this is my buyer, and he's fixed it up. He's improved it. He's actually buying one of my other houses and renting it out. So he's becoming a landlord. We don't become the landlord. We become their owner financing. That's what we do. We buy the houses, at that margin, at that mark, 30,000, somewhere a little more. And then like I said, we buy a house like a car. We sell them like a house with owner financing. And that's what we like to do and help people get out of their rental situation and be able to be homeowners over time, because it's amortized through contract for deed.
A friend of mine has a portfolio like that. He's got about 250 houses, mostly in the Midwest, that he did that for. And I talked to him a couple years ago. And so in your situation where you're carrying that contract for 5 years, but you're looking for some debt to leverage that for the 5 years, right? We looked at that, and that's actually, if someone was going to give you a loan for that, it's actually a consumer purpose loan. It's really hard to do with hard money. I went down the rabbit hole with a friend 2 years back, and it's really hard to find, next to impossible. We ran it by an attorney, and they were like, "Yep, can't do it. Here's why." So because it's consumer purpose rather than business purpose.
Yeah. Of course, I don't know how that operates,
Yeah.
but it usually, like the Roth IRAs, the self-directed, those are really good. People who aren't making 12% in different markets, and so they're getting paid their P&I right away for 60 months. And that's what I'm saying. If you have private lenders that have that type of Roth IRAs, that's all I can think of right now. Vehicles, where they have to put their money and keep it there for some time anyway, right? So they might as well make a double-digit return. But there are some. We do lend from institutional groups. Can you think? Offer Market's one of them. You may be familiar with them. But so that was just something I wanted to find out. How much is your individual lender pool, and are they geared to entertain this type of lending?
That's it's something like that. It's so if you're on smaller dollar amounts, we really don't look at anything below 200,000 as far as a loan amount goes, and so we get a ton of requests like that from the Midwest or from Louisiana through the website. But
What about like package deals? If we had like a pack of 6, 8, 10 homes, and then now you're looking at 100,000, maybe 200,000 loan, but it's for it's for multiple homes, single family.
Yeah, we couldn't do it because you have a rent to own structure, or lease to own and so the end user is a consumer purpose, and so that's why it would require all kinds of consumer purpose licensing for that state. It's most private lenders just won't even bother with it because they don't have the licensing or the intent.
Yeah, that's the trick is that we're strictly business purpose, non-owner occupied investment loans. So we can't be lending on properties where the borrower is the occupant. of the property. And it sounds like that's kind of the way it's structured. The minimum loan size thing is a challenge too, but yeah, and I apologize. You can definitely clarify there, but
Yeah.
The occupant of the property would be this individual moving into the property after you purchase, correct?
So I purchased my property. I owner financed for the buyer. The deed stays in my name for the duration of their loan. So
Gotcha.
I am the owner until the end of their contract, which is amortized over 30 years. So they're borrowing on a regular home loan basis, but it's seller financing or owner financing, not really seller, but owner financing. We hold on to the deed until the duration of that contract is met, whether it's 30 years down the road, just like us with our own home, 30 years down the road or 5 years down the road, they've got equity and they sell it, and vice versa. So that it is not owner occupied.
It's not owner occupied.
Got it. Yeah, that makes sense, and it's definitely interesting. I think the biggest challenge is less so that, but the minimum loan size with the national lenders, it just becomes difficult. Like Ted's is a little higher, ours is a little lower. Our minimum initial loan amount is $75,000, but that's an initial loan that is $75,000 is the minimum loan disbursement. So if we're doing 75, 80, 85% of purchase, then your purchase prices would need to be, $95,000, $100,000, something like that. That minimum does lower when we do have portfolio loan options available to where the minimum initial loan is $50,000 per property, but each property needs to achieve an average loan size of $50,000 per property. So $50,000 at 75 to 85% of the value of that property, if that makes sense. Sometimes local lenders have lower minimums and might be a better fit because they're in that market where these lower volume transactions are happening.
Yeah, definitely go to a local lender. Like if you're borrowing in Ohio, isn't that where you're doing a showing right now?
Yeah.
Find somebody in Ohio, they'll do $30,000 loans. They know that market. Yeah.
Okay. Very good. Thanks, guys.
Yeah.
All right. I'm going to move us on here, maybe. Okay. So we did this lovely comparison just so you can see what the different terms would be with institutional private money. I think most of us in the room are probably on the resi fix and flip and resi construction. Bob, do you want to go through this since this was
kind of? I mean, I think it's gonna. So, is everyone gonna get a copy of this presentation?
Nope.
Okay, so I'd say your big thing here is like take a screenshot of this. So you can like refer to it later. At a high level, like with residential fix and flip, you're looking at that's 1 to 4 unit fix and flip properties. You're going to be able to get your highest leverage on those kinds of properties from an institutional lender, up to usually about 90% of cost. And the rates, if you look, they're all relatively similar outside of the DSCR, which is long term. So you're looking 9.5 to 12% on the rate and a couple of points and everything else. I think your real difference here is going to be in the term and the leverage point. So your highest is going to be on resi fix and flip. It goes a little bit lower, but still pretty high on ground up construction for residential. Your bridge loan is going to be, kind of tapping out in that 75, 80%, kind of like think about it like a bridge to kind of a Fannie and Freddie conventional loan. So we won't really push the loan amount beyond what a conventional lender would give you. And then the debt service coverage ratio, or DSCR, debt service coverage ratio loans, those are like long-term rental loans. Pretty challenging to get a good rental loan in this kind of interest rate environment, but at the same time, it's tough to get it's tough to get anything done on a rental side right now. But you're looking in like the 7.5 to 10% kind of range on those. The other thing I said difference here is like, resi fix and flip, you're looking at like 6 to 12 months for an initial term, like in and out kind of stuff, a little bit longer on construction just because ground up could take longer. Bridge usually gives you 2 years to kind of fix whatever you need to fix kind of on the personal credit side or something before you can go and get a conventional refi. And then the DSCR is that kind of long-term rental loan. You're thinking like 10 to 30 year kind of term on that sort of stuff. And usually there's prepayment penalties on those if you pay them off within the first like 5 years.
And IO means interest only for folks that don't know what that means. And AM means amortized.
Yep.
Right. So principal and interest. And then credit check, liquidity, meaning you have got reserves, and what's EXP, experience?
Experience, yeah. So I mean, like basically if you look across the board, like most of these are very similar, except for the DSCR. Like the DSCR is significantly longer term. It's a little cheaper. It's more of like a longer term rental loan, but you can hold it in a LLC. It's you know, just think about it like a longer term rental loan. Everything else is just like shorter term, higher interest, in and out kind of bridge, you know, a bridge to either a sale or to a refinance.
The nice thing about debt service, the DSCR program, for those of you that might not be as familiar, is, you know, as compared to a conventional 30-year fixed loan, the bank is underwriting your personal debt to income. They're getting your tax returns. They're, you know, figuring out what your debt to income ratio is and making sure that based on your W-2 income that you can service that debt. With the DSCR product, it is very much more asset based. So we're looking at the income that the property generates, or the potential income that the property generates in the event that, you know, maybe you're just finishing up a rehab and it's not rented quite yet. We can look at market rents and assess it based on that. But basically we're looking at what are the actual rents or the potential rents. And then we divide that by your monthly expenses, principal, interest, taxes, insurance, any HOA fees. Most lenders want you to be at least break even or better, which means a debt service coverage ratio of 1.0 or better, which means your monthly rents are at least, you know, 100% of your monthly expenses. Hopefully higher than that. You know, the goal is cash flow. But in this, like Bob was saying, in this interest rate environment, you know, sometimes break even with the appreciation play in the future, just hoping to break even, kind of ride it out until rates drop and you have the ability to refinance and allow the property to appreciate in value. Sometimes that's the best play you can make, and lenders understand that. So that's why they're okay with you just breaking even. But that's the nice thing about DSCR. We're underwriting the property income, not your personal income. And then the other thing I just wanted to touch on the bridge loan, it is, like Bob said, bridge to something else. Another use for a loan like that, I work with a lot of builders or high-end flippers who are just finishing up a rehab, still plan to sell the property, but they want to keep their funds rolling. They want to tap into that equity, get a 75, 80% loan to value, cash out, refinance, take that money and go buy their next project while they wait to list and sell the current one. So we're seeing a lot of that happening right now as well.
Yeah.
Do all three of you have DSCR products? I wasn't aware of that.
I believe
yeah, we should.
Yeah.
And then also just real quick, LTV on DSCR. I mean, is that pretty fixed with you guys? Because the one DSCR that I have is 85 LTV. So I'm just curious.
Well, so here's the thing when it comes to DSCR,
Yeah.
like
It's
like LTV and DSCR, they're kind of two sides of the same coin. So like
Yeah.
if you like a lot of times if you're scraping by at like a 1.0 debt cover, like
Yeah.
that's your lower debt service is going to be your higher LTV. And so
Yeah.
if a 1.0 cover ends up, you know, sizing your loan to a 65, like even though we can go to 80, you get limited to a 65 because
Sure.
of where your rent is at. So
Right.
like 80, 85, usually with these kind of rates, like the LTV on these DSCR loans doesn't even matter because it doesn't come into
Right.
play. Most often it ends up getting debt cover limited.
Yep, the DSCR is usually the limiter in this environment right now. So just something to keep in mind is, you know, in this day and age, like sometimes, you know, you're not going to get that perfectly executed BRRRR where you can get the 80, 85% loan to value and pull 100% of your capital out. Sometimes you need to keep a little bit of that capital in so that the property achieves that debt service coverage ratio with the intention of refinancing as soon as possible, you know, when rates go down or your property appreciates.
Mm-hmm. Or if you're following economic news, if rates go down, but
if they go down, yeah. Yeah, that can keeps getting kicked down the road. So anybody that's betting on that happening this year, I think the odds are pretty low now.
Suzanne, I know that, you know, I mean, I think there's a few more slides here. I'd want to make sure that there's time for people to ask questions or anything. So like, feel free to at least interrupt us if we keep going on this. Like if you have true questions, raise your hand or just shout them out because, you know, we're here to help you get your questions answered about, non-bank financing. So just feel free to jump in if you got any questions.
And I think the question Sarah was really asking about like DSCR and any of these, for folks that don't have like a ton of money sitting around and they still have to show liquidity, is like, how can you reduce your out of pocket cash?
Seller financing, or doing what I talked about, where like you get creative with broker commissions and like honestly, the best way is to get subordinate seller financing. Like, get creative, talk directly to sellers, and then get them to finance 20% of the purchase price as a junior loan. That is your best way to go to get like limited cash out of pocket.
Yeah.
And if someone were borrowing from one of the three of you, would you allow a seller second?
So with us, at least, like if we'll go to 90%, if you're bringing your own cash down, we'll go 90% LTC. If you're bringing your own cash, we'll usually haircut that like 10%. And so we'll be at a max 80% LTC, which is why I said get your seller to carry 20%. So it's just, we're going to margin ourselves a little bit. If you don't have any skin in the game, we want to make sure that our leverage point is lower. But again, you can screw with purchase prices, like offer a seller two different scenarios. Hey seller, I'll buy your place for 300 grand, with zero finance, all cash to you, or I'll buy it for 330 with, you carrying 20% down. So they get a higher purchase price, right? But they have to play ball a little bit. So, you can kind of structure it that way to try to appease your seller into taking more of a subordinate carry structure.
Yeah, that's good stuff. Yeah, the way I explain it to folks, the way our guidelines are set up is we'll go up to 85% combined loan to value. So if I'm able to do 80% on a rental purchase, you could get seller financing for another 5%. Or if I'm at 75%, you could get seller financing for another 10%. But there's always going to be a skin in the game component there.
Yeah, same with us. We want to see some skin in the game. A lot of people try doing it, but most of our investors are pretty experienced with real estate and finance, and they always push back, like, why am I taking all the risk? And this guy and the borrower has nothing in this one. Like,
but at some point, isn't it moot, right? Like if they came in and said, "Hey, I got the seller to carry 40%. Can you do a 60% LTV loan?" Like, what lender in the right mind wouldn't do that, right? As long as the numbers kind of check out.
They're fickle. They're very fickle. There's like, we want to see this guy coming in with some money, this woman coming in with money.
Lenders have differences, right? You can see it right here.
Like,
as long as you have enough, in our case, from a seller, you're able to do it. But in general, doing that, getting your real estate broker license, and I'm not saying that to like say, cut Sarah and Suzanne out, because they find you friggin' awesome deals. But if you're able to get them paid on a deal you brought in and then increase the price and still get an extra little broker commission that just came out of thin air to help reduce your down payment, like friggin' do it. So there's always ways to be creative, and the more kind of tools you have in your tool belt, whether you're a broker and have your license, whether you're negotiating seller financing, doing something else creative, always cool ways to get there. But like the more tools you have, the better able you are to execute.
Yeah, partnerships are often a good solution too, to that problem, especially on the shorter term stuff. A lot of times, if you have who would otherwise be a private money lender that would be willing to come in second position, but your private lending institution restricts you in that regard. You could, if it's somebody that you trust, that you have a good relationship with, consider bringing them on as a partner, adding them as a member to your LLC or doing a joint venture. Lenders like us can get creative in how we work with you on that. Like for us, as long as if you've got a new member, they're added to the LLC. We only need one borrower on our loans that has at least 20% membership in the LLC. And that's really all we care about. That's our borrower. That's our guarantor. So,
well, a different approach as well. If you look at like how second, we think second position lenders, right? And second position, most people think is actually a second lien on title. But if you look at what large institutional, commercial real estate do, like no mezzanine lender, mezzanine being like a junior lender, no one puts a lien on title, because these firsts are too big to take out anyway. What they do is they give the LLC the money, and then they actually take a security interest in the LLC membership interest. So they'll take a UCC filing on the LLC membership interest, and if the mezz debt defaults, they literally just swoop the LLC from the borrower. And that would be another way where if you set it up to be like, hey, they're a preferred equity partner, or they're a mezz lender that doesn't take a second, but instead takes a security interest in your LLC, that would be a way to get around a lot of this stuff because you wouldn't have a second on title. Again, I might have said a lot there, but like, let me know if you have questions. Happy to talk about it offline.
That's why we record this too, so we can back and listen later. Yeah, that's really interesting. I love the creativity, and I know that's most people's constraint is just the cash out of pocket. So I want to make sure we touched on that. I know we're after time. A few people have left. This is pretty clear. You know, we know banks are most strict. Institutional is kind of second level in terms of what they need for underwriting, and then individual would be least strict with maybe no docs needed. But I think this is really important too. Just we've talked a lot about a lot of this, but not side by side. So just wanted to compare the institutional pros next to the individual cons. I think this is a great way to look at it. So institutional money is generally cheaper. You can get construction financing. You can find these places online. You know, they generally have funds available and they're reliable. You get what Joey was talking about with that professionalism, responsiveness, higher level of service, and they've got processes in place. And also they're there to protect you and evaluate your deals so that you're not making a bad investment. Whereas you know, when you're borrowing from an individual, it might be more costly. Like Cherie said, she's paying 12%. It can be harder to get construction draws, and or there's no process for that. You have to network to find these folks. It's kind of the Wild West. These lenders may have no experience and they're just trusting you. And they may not know how to evaluate your deal, meaning that it could be riskier to you because they're only going based on what you're telling them and they're trusting that you know what you're doing. Maybe you do, maybe don't.
I love telling borrowers like, hey, thanks for bringing me this deal. I don't think you should do it. Or telling borrowers, look, I'm not the right one for this. Like, I don't think it's the right deal. Or like, you should go somewhere like, and I think Joey and Ted do the same thing where, you know, we want to see you succeed because where we make our money isn't on one deal. If you think about like the commission on one fix and flip loan, it's like pretty minuscule. So where we are financially incentivized is to make sure you succeed. So we do a bunch of loans together. And so telling people, look, this isn't the right deal, keep looking. Or, you know, I'm not the right lender for this, but I think you should structure it this way and go with that guy and setting them up. Like we always refer deals back and forth depending on who's the best lender because we are really motivated and financially incentivized to see you, the borrower, succeed. So
100%. And that makes me think of appraisals too. A lot of times, you know, most of us are going to require an appraisal. I believe we do at my company. And, you know, sometimes even the most experienced investors have a tendency to overestimate their after repair value. They think their house is going to be the nicest one on the block. They're going to have the best finishes. They're going to have the elongated toilet bowls and the nicest backsplashes, and they're going to outperform every other sold comp on the market. But, you know, sometimes it's good to have that appraisal to rein your expectations back in, because what you got to understand is that your end buyer that's going to buy that property is likely going to be financing the purchase of that property, and they too, that loan at the end will be subject to an appraisal as well. So it's good to know what an appraiser thinks of what your after repair value is going to be going into the deal ahead of time. You know, it's just another safety net for you.
You know what I love? I love it when someone sends me a spreadsheet for their underwriting on a deal, and then they have like their comp analysis, and then they're like, oh, well, this is gonna be a 9-month project, so there's market appreciation for 9 months, and they boost it, you know, like 8%. And it's like, dude, if you can't like get a deal done with your comp set, like instead of thinking about it, like what's the upside, how about you look at like, all right, where's my break even? Like, what do I need to sell this for before I start actually losing money? And like, how confident am I that I'm definitely going to hit that, and I'm likely going to hit my true comp set? Like, let the upside just happen, right? And be happy about it. Like, make sure you're protected on the downside on these deals, because that's really where people lose, especially when they're first starting out. Like, if you don't hit your first deal or two and do either break even or better, like, you're not going to be flipping houses. You're going to be like going back to your W-2 job and trying to, you know, scrape together another down payment for 5 years. So like really being conservative in your underwriting is especially on the first few deals, like just making sure they're good is critical. I've seen a lot of people be really successful because they did that. I've seen a lot of people lose their, not their house, but close to it because they didn't.
That's a great point. So just looking at the institutional cons and why you might want to choose an individual private money lender. Usually institutional can close within 1 to 3 weeks, whereas an individual, if they've got the money liquid and ready to wire, they can close in 24 hours. Institutional is going to need approvals, whereas individual generally doesn't require needs appraisal, whereas an individual generally won't. Institutional will be lower LTV and more structured. We talked about that, whereas an individual would be higher LTV. You would have, what was this other thing? Oh, rehab draws on institutional, whereas you may just get like a full lump sum from an individual.
Or they just won't finance it. They'll just be like, hey, I'm going to finance your purchase. I'll give you 80% of the purchase price, but you got to finance the rehab out of pocket. Because a lot of these guys, they don't want to deal with draws and like future funding requirements and all the title, the title exceptions and stuff that go along with that.
Yeah.
And typically you're paying monthly interest and you pay your points up front for the institutions, where individuals, you might negotiate something different. So we just wanted to quickly run through a couple of examples. I know Sarah's doing a flip, and then Karen's also doing one as well. So Sarah, take us away.
Oh yeah, I mean, it's what's up here. It's pretty straightforward. I mean, my experience was pretty limited. We'd only done live-in flips, but somehow we were able to convince Bob to get us a 90 LTV. Our deal has a pretty nice spread. We purchased it for $375 with some credits, and I mean, very, very conservative ARV on ours is $650. Probably gonna get closer to $750 on it. $100K, maybe $120K rehab costs at the end of the day. But yeah, I mean, I'm happy with our terms, and the draw process has been really smooth. We got $30K up front right away for rehab funds, which was super helpful. Interest only payments. Yeah. So.
And I think that is definitely one thing that I'll just plug merchants, our company here, a little different than a lot of other lenders is, and like I said, I'm dealing with this friggin' apartment complex that I'm rehabbing, is I'm out of pocket $300,000 begging my lender to give me some money to like refill the coffers. But with merchants on the resi fix and flip side, we'll basically front you your initial draw. So you're eligible for 30% of your rehab budget up to $30,000. Like the day you close, you can request it, you get the money. So you don't have to think about, all right, I just paid all this money to close and now I need to make sure I've got enough money to actually get this project started. You should theoretically not be out of pocket any additional cash during the project, as long as you're running the draws right and your deal is, you're not spending $50,000 every 2 weeks on it.
Mm-hmm. Yeah. Yep. So, I mean, like it says here, I mean, all we had to do was provide our investment analysis. They did an as-is and an ARV appraisal, credit score, and a detailed budget. Well, and your budget doesn't have to be that detailed either, So,
but highly recommend being more detailed than less. You see a lot of times when these inspectors come through, and if you're more detailed, you have plumbing rough, plumbing finish, plumbing rough kitchen, plumbing rough bath. If you have those separated, they'll give you 100% credit for what's done, instead of just saying, hey, inspector, like, what do you think my plumbing line is at? And these guys are like, well, your finish isn't in, you're halfway done with the kitchen, you're not done with I'm going to give you 15%. And it's like, well, shit, if I'd spread it out, I would have gotten, $18,000 in a reimbursement instead, because I kind of bucketed it all in one. Like this guy just gave me like 10. So I've seen people really get screwed by not putting more granularity into their budget.
Mm-hmm. Yep.
Okay. And then Karen, do you want to talk about yours?
Sure. Mine's somewhat similar in terms of terms. We've got a flip that we're doing over in Deschutes River Woods. We got it for $925. We've got about $170,000 for the renovation budget. We got 87-ish% loan to cost. So we had to come up with like, I think 12.85% down. And yeah, we just needed the liquidity, and we had to come to the table with a check for $160K that they put in their account, and then we bill against that, which is something that, since this is our first fix and flip loan, I didn't initially realize. I thought since we had the liquidity in the bank, we were actually going to be getting a check for $50,000 from you guys, put it in the bank with our money, and then we could just draw off our own money. So then, realizing the difference is just kind of a different mindset that makes perfect sense because you don't want to risk, that money or your investment. And so that's, you got some money in the bank that we need to bill against. And yeah, it's a 12-month term. I think the ARV, we're looking at 1.5.
And did you guys use some sort of like partnership method or anything like that to help finance part of the down payment, or did it just come straight out of pocket?
It came out of pocket. We do have an LLC that's the land holder for the lot and sisters. And so just as I guess an extra layer, our partner in that LLC wrote a letter that said if we needed to use some of her funds, we could. But we never have to, I don't think we're going to have to tag her funds. And that was just, I think it made everybody feel more comfortable. Yeah. So it's been easy so far. We did our first draw, took a couple days. It's great.
Quick turnaround time.
Super. It's always just interesting to see the different nuances of how these deals get structured because they're not all the same. And then finally, just wanted to talk about how, I know Whit, you mentioned at the beginning that you're interested in perhaps becoming a private money lender. So, I think Ted is probably someone you might want to talk to. Ted, do you want to take this one and just speak to it specifically to how your company works?
Whit, good to see you. We were neighbors. Oh, Whit's on.
Oh, you're muted.
Yeah, I was on mute, but what was the question, Suzanne? Sorry.
Just how people could invest with First Capital Trustee, like what your threshold is. I know there's other like institutional funds that allow people individuals to invest with like a minimum of $50,000.
Sure.
Maybe they have to be accredited, maybe they don't. Various requirements, but yeah, how do you?
So our company's based in California, so we always go off of California's guidelines for trustee investing. The California Department of Real Estate has something where you have to have a minimum $1 million net worth, and each loan can't be more than 10% of that net worth. So you could only do $100,000 on 10 different loans is how you could do that. So we tend to stick to that across every state that we lend in. Most of our trusted investors have minimum probably 5 million, up to one guy has 200 plus million. And they usually like to lend on stuff that's local to them when they start out doing stuff. As we've done more and more deals with them over the years, they've branched out into different markets, taken on different types of projects. Our company as a lender, we usually won't do anything for like less than $250,000 on our first time working with a individual trusted investor. We provide all that upfront things, just like if someone was going to get a loan from Bob and Joey, they would do all the due diligence. We provide the lender with that as well, so they can double check what we've looked at. And then we create loan docs for them, draft the loan docs, handle all the funding and closing, and then also set up loan servicing for them through FCI, which is down in Anaheim. And so we basically do all of it. Their role in it is just approve the deal and then wire funds and then get our DocuSign for setting up loan servicing is how we've created it for our investors. And we, as a company, we do probably 75% of the loans we originate each year. So we're drafting the loan docs for our investors to fund the loans.
Okay. So Katie, we're going to talk about your question next. So the way you can be an individual private money lender would be doing a self-directed IRA. So say you left your corporate job, you had an IRA left over, 401k, you can convert that to a self-directed IRA and loan money directly to other investors. Like basically what Cherie is looking for is for someone to do that more direct lending from a self-directed IRA. And the way you do it with a self-directed IRA is, you're investing in her thing, in her investment, and then the money, anything she pays you goes back into that IRA. It doesn't come to you individually, and that's how you keep the tax benefit of an IRA. That's very general terms. So, but you would have to like bear all the risk and know what you're doing and trust their underwriting and all that stuff. So
Suzanne, can confirm or let me know if I'm mistaken. You're kind of almost straddling the line between like, because I think that first one was more talking about like an institutional private equity fund that does, kind of private debt. And so that would be a high net worth individual goes, puts 50 grand with a company like mine or Joey's or someone else, and then we actually go and lend that out. But that's, we're in control of that money. Whereas I think what Ted is doing is more finding these, individuals, maybe with an IRA, maybe not, but, kind of finding the deal, finding those individuals, putting them together, setting up a servicing. So it's kind of like you're not in the Wild West as an individual lender. You've got, kind of like a concierge to help you through the process and find the deal and vet it. So I almost kind of like straddling those two. Ted, is that a fair statement?
Yeah, that's exactly it. Yep.
Okay. So then there's basically 3 ways to do this.
And we have some of our investors also invest with in mortgage funds. So there are some mortgage funds that, like Bob's companies, Joey's company, smaller versions of them that are registered. They're listed on the Charles Schwab portal or the Fidelity portal, and you can invest in their mortgage fund. Let's say minimum $100,000, and you can invest in it through your Schwab account. So some of these smaller mortgage funds, like we have one in San Diego that's 100 million or so, and they're on Fidelity and Schwab, and so they get some money from that. It took 2 years to get certified by each of those companies to get on their portal, but now they continually get new money coming in, and it's mostly done through RIAs, registered investment advisors.
And then there is kind of another, and just because I think, and Whit, correct me if I'm wrong, but you said, hey, I've got a portfolio looking to potentially sell out of it, maybe do some seller financing, maybe just lend the money if you sell it. I'm not sure what you're thinking there, but right, I mean, you can be a private lender as a seller financier, right? So you have a company, you sell it to someone else. Whit, sorry, go ahead.
Oh yeah, I'm aware of that.
So, so is that what you were talking about, or are you talking about actually investing in / like after you sell, pay the tax, and then use that money to be a hard money lender?
Well, I was interested in learning what the possibilities were. So
Got it.
All of the above.
Got it.
Okay. Well, I think that's it. And I can't even get this thing to go forward. So, any other questions? Oh, I guess that's the last slide. Any other questions? No? Someone did ask me for a sheet of all your contact information, Bob, Ted, and Joey. So I will put that together. I'll put it on the Central Oregon Investor Network Facebook page, which hopefully you're all on. And we will post the recording. We will post the chat. And please join us next month. May 16th, I think, is the date. We're going to be talking with Cherie about out-of-state investing. Sarah and I will both have stories to add from our experience, and anyone else. But yeah, we are excited to see so many return attendees, and yeah, look forward to chatting with you all and learning from you all this month.
Hey, Whit, quick thought. If you are thinking about selling out of your portfolio, right? I mean, there's obviously going to be a pretty big tax implication there. I'm happy to connect you with this company, but they were at my 1031 QI on a couple of deals. And then I started talking to them, and they're super creative, but they do these things called deferred sales trusts. And so, but I can get into the nuance. It would take a little bit, but basically you wouldn't pay your cap gain on that. It would be like a deferred sale on that, but you can direct those proceeds to be used. So if you were going to sell your properties, pay tax, and then use those post-tax proceeds to go lend, it might make more sense for you to sell into a deferred sales trust, lend out of your DST, your deferred, not Delaware statutory trust, but deferred sales trust, and then have that income funneled back to you.
Oh, that's interesting. Well, I'll contact you more about that. I only have one more property to sell because most of my properties I'm going to keep. So,
Got it.
And I did just write a check for, well, I just paid $150,000 in taxes.
Worst.
But I probably won't do that again.
I love it. Good to know there's an alternative and some creative ways to.
Yeah, like if you're ever gonna blow a 1031 and you don't want to blow it, you don't want to pay the tax, you can set up a deferred sales trust last minute and have it be sold into that deferred sales trust through a carryback. And so then there's no actual gain that hits you, and the gain is trapped up at the deferred sales trust level. And then you could direct those proceeds to be used in whatever way. When you unwind it all, you have to pay the tax. But like if you're going to be earning 12% interest or some shit, you might as well earn it on your pre-tax dollars instead of your post-tax dollars.
Yeah, no, that's great. That's a brilliant idea. Thanks for sharing that.
So smart.
Awesome.
Love it.
Well, thank you all.
Thank you, Suzanne and Sarah and Ted. Good to see you
Thanks,
again.
guys. Nice to see you.
Thank you guys. Thanks for the opportunity.
Yeah, thanks for having me on. Suzanne.
Thanks for being here, everyone. We appreciate you.
Appreciate it.
Hasta luego.
Hi, do you want me to get your contact info?
Yeah, I think this is the first one. I found you guys on Meetup, I think, and then I got and I was like, I've been thinking about that. So this is the first time I've come, but this is really good. And
Love it.
yeah, I'd like to be on